Okay, so we can start. I would like to introduce you our speaker. So today we're gonna have the webinar with Vincent. He represents French venture fund. They have a huge experience of investing in different startups from all over the Europe, and as far as I know, currently they are moving to a new locations. So they are looking for some new opportunities in different markets and in different countries. And Vincent himself is the legal catalyst of the venture fund, and also he has a huge experience in working with different startups and making the deals for them and like supervising that everything goes well. And today we're gonna talk about startups and venture capital funds. So supposedly what you need to do, what is the steps to do while you are raising funds, and what are the actually obstacles or the problems that you can face while getting those investments from different VCs or angel networks or different kind of investors in general. So this is in brief what the topic is going to be about, and I would like to give already the opportunity to Vincent to introduce himself and to move forward. So Vincent, nice to meet you and thank you for accepting the invitation to participate, and the floor is yours.
Thank you very much, Mariereko, everybody. So thanks a lot for having me tonight. First, I hope you and all your relatives are safe and sound in this kind of lockdown period / crisis. So my name is Vincent Robert. I'm French, of course. I think you get the terrible accent, and Chief Legal Officer in OneRagtime Venture Capital Fund. So we are a venture capital fund which is based in Europe, so between London, Paris, and Barcelona, and in Southeast Asia, so in Ho Chi Minh, Vietnam, and I am right now in Ho Chi Minh. So OneRegtime is an investment platform. We are backed by a community of investors which are usually investing early stage tickets, so from let's say 250K to 1.5 million euros. And then we are doing the reinvestment if the company we already finance. So we are doing the Series A to Series B of the company we already got in our portfolio. So in OneRegtime, we are investing through a fund like all the venture capital funds. So we got a company which is dedicated to invest on several companies. And we are investing through investment vehicle, which is like a little bit different. It's like a one-shot investment mechanism. So which means that the purpose of the vehicle is to invest in just one company. So, and like Ovanes told you, I'm Chief Legal Officer in this fund. So, which means that I am in charge of the structuration of the funds and the investment vehicles. Then I am in charge with all the analyst team of the negotiation of the term at which we are investing in startup. And then I am sometimes working from our portfolio company when they got some issue with legal and regulation matter. So my background is like, it's not very original. I did law, so I had bachelor in business law. Then I do a master in financing law. And after that, I had another master in merger and acquisition law. And after my university, I worked in a crowd lending company in Paris, then in a crowd factoring company in London. Then I came back to Paris to work in a venture capital fund, which is called New Fund. And I joined OneRagtime 2 years ago. So firstly in the Paris office and then in Ho Chi Minh office. So, and that's pretty well. So maybe we can begin the presentation. So if you have some question during the presentation, just put it in the chat, and Ovanes, you will tell me, like, feel free about it.
Okay, perfect.
Yeah, sure. Okay. So this is the kind of the little schedule of the presentation. So, so the purpose of the webinar is just to fly over the startups and VC ecosystem during the section 1, and then we'll take some time to talk deeper into the fundraising startup with a VC fund during the section 2. So I don't know the type of listeners we got today, but I imagine you are like entrepreneur, or you want to be entrepreneur, or at least you are in the startup fund ecosystem. So I think, yeah, the presentation will you will already know what I'm going to tell, but I will really be happy to answer to some questions or to go deeper. So first, we are going to talk about the startup. We'll have a little quick view about startup, because I know you already know a lot of stuff. We will just talk about startup from an investment point of view. So first, the first slide is about the startup life cycle. So here you can see that usually when we are in venture capital investment fund, we are dividing a startup in its life cycle. So we are going to see if the startup is at the first life cycle. So it is a bootstrapping stage. You are just at the beginning. You are going to try to find your product market fit. This is the first life cycle. Then if the company is like a little bit older, we are going to say, oh, okay, this company is in the seed stage. So it's already got a product. Then the company will want to just find its market fit. And then after that, we are going to check the creation stage, which is about the scale up. It's all the company who will go to series A, B, or C. So usually in OneRagtime, we are investing in the 1 and 2nd life cycle company. But just to illustrate the kind of money you can have, like family and friends support, low investment, all of this, we are going to talk about it later, to adjust to put on the slide. Now we are going to move to something which is more famous, which is the business model. So every time we are going to receive the pitch deck of a startup, the same, we are going to just classify the startup in its business model. So it's very famous. It's a strategic notion, in a sense that it's the company's plan for making profits. So broadly, how you are going to define your business model, it's just through 2 data. You are going to check the product or the services you are going to sell, and you are going to identify the target market. So I'm sure you're already familiar with these 3 business models. So we got the B2C, business to consumer, B2B, business to business, and B2B2C, business to consumer. So I put some just illustration in order to be a little bit more meaningful. So for instance, Amazon, everybody knows Amazon. If, I don't know, you want to buy a candle, you are going on the shop online and you are buying your candle. So you are going to buy from a business company, so B, to you are consumer, C. Amazon is very interesting in this case, because if we are going to the B2B business, Amazon got a B2B business too. For instance, it's Amazon Web Services, so which is hosting the data of companies. So it's a B2B business. So it's very interesting to see that sometimes one company can have several or 2, in this case, different business models. And the B2B2C, it's a very good business model. We don't see a lot. So I put the company Hero. So Hero, I don't know if you know, it's a customer experience company. So basically the business of Hero is just to selling to close retailer. So Hero to close retailer, B2B, an experience for the customer of this close retailer. So B2B2C. So it's a kind of business that in OneRagtime personally we like. I put some kind of pros and cons for every business model. Actually, you are not going to choose your business model with a pro and cons, just about, like I said, your product or services and your target market. So it's not about, like, I mean, your business model is something about what you are going to do, and not about the pro or cons to do a B2C, B2B, or B2B2C. And the business model is closely related with the monetization models. So I'm sure it's the same. You are already familiar with this kind of monetization models. So this is kind of the final piece of a systematic look at a business for a VC, because at the end, every company needs to have a model that successfully generates revenue, of course. So we are going to every time check where the company can have right now its revenue, or in the future can have its revenue. So here we just summarize 6 kind of monetization model. So we can subscription, commission, advertising, licensing, direct sale, and e-commerce. And the same, in order to be a little bit more meaningful, I just put like the same 6 model with some company you already know, of course. So it's a little bit how to say, easily to just how to say, to have the image of the monetization example. So again, there is not any best monetization model that another one. It's just about your product or the service you are going to sell, and about your target market. These two data are going to help you to find the best monetization and business model. So now we are going to stay on the startups, but we are going to look at them with again a more how to say, financing eyes. So of course, finance eyes, so financing options. So basically, fundraising is here to give you money. Here you can see the 3 main types of financing for a startup. So as you can see, you got the loan, the equity, and the convertible note. So the loan is you are very familiar with the loan. It's the same, like even when you want to buy a house, you need to go to see the bank and say, okay, I want this house, I need this money. The bank will do a loan to you. They will like just not give you some money, but like just how to say, you are going to borrow money and you will have to pay this money back with an interest rate. Then you got the equity. So equity is kind of the main financing option for startups. So it's basically you are going to get money and you are going to get some shares in order to pay this fundraising. So we'll come back to this after. And then you got the little mix. It's like the B2C, B2B, and the B2B2C. Every time there is a mix. So convertible notes is a mix. It's part of a loan because we are going to give you money. So this is a convertible note. It's a loan. And then the loan will like, how to say, it will like just transform in it will convert, sorry, in equity. So this is the 3 main financing option. So the best financing option will stay the reward you can have after a competition, or I don't know, after a summit, this kind of stuff. But I didn't put it here because it's not the purpose of the webinar, but of course you can put reward if you want here. Then we are going to talk about the different funding rounds. And again, I'm sure you saw a lot of press article saying, oh, this startup just raised its seed round at Series A, Series B, Series C. Because you have to know that from a venture capital fund view, the startup will not raise only once. The startup has to raise at different stage of its life, of its business. And each different funding round will involve different purpose, different amount, and different kind of actor, kind of investor. So I will come back to the seed just after this slide, because this is where I am specialized with OneRagtime and with my past experience. But Series A, Series B, Series C, we are already on startup who already raised from around 1 to 3 millions. So it's very funny because if you are going in US, so this is all the amounts you can see on this slide are the kind of European point of view. But if you are going in the US, for them, seed will not be 250K. They will say, oh no, for me, seed is like from 1 million to 5 million. Series A, like 7 million to 20 million. So it's very funny to see this, like every investor have their own kind of funding round, how to say, funding rounds, understand. So yeah, so this is what I told you. We'll have a focus on early stage financing, because when I introduced myself at the beginning of the webinar, I told you that OneRagtime was an early stage venture capital. So an early stage is basically the period from your first money in your bank account of your startup to your first professional fund in your equity. So it can be a lot of stuff during this period. So as you can see, I just subdivide this early stage period with some different steps. We can call it like this. And so I just put different investment player. So the founder, friend, and family at the beginning. Then you got the same. Then you can go in accelerator. Then you got the angel investor. So it will be the first fundraising, kind of fundraising, because it's not professional investor. And then you will have the early stage VC, and then venture capital. And after that, you can come back to the previous slide with the seed, Series A, Series B, Series C. So as you can see at the right of the little graph, I mentioned the bootstrapping phase, because the pattern you can see on this slide is not the only pattern you can find. Sometimes you can find some startup which we call them bootstrapping startup. It's kind of startup which can financing themselves with their own revenues, even from the early stage financing. So this pattern does not apply to this kind of company. And the same, you can, I put some stuff like, so the different actor, friends and family at the beginning, very, very beginning. Then you got the accelerator, angel investor, venture capital fund / early stage capital fund. And so there is something very interesting because we are seeing more and more new ways of financing since maybe the last 10 years. And this is an explanation about the fact that this early stage of financing developed itself years after years. So for instance, you got the crowd equity, which appears maybe 5, 6, 7 years ago. Yeah, and then you got the pre-sale, for instance, on Kickstarter. Let's say you got a product. You can go on Kickstarter and just do a kind of early stage financing, which is like you will say, okay, I want to produce this kind of product. I will sell this product in advance. This is a pre-sale. And then I will begin to make this product. And you got a new way of VC fund, which are going right now. And I think, according to me, after the crisis, there will be a lot of this kind of venture capital. It's some early stage venture capital firm which will say to you that, okay, I will not invest to you and take equity. I will just invest and take a percentage of your revenue. So it's not equity-based financing, but it will be like revenue sharing agreement. So these three things like crowdfunding, crowd equity, pre-sale, and new kind of VC will growing in the next years. So you will still have a lot of early stage financing around, which will appear. So this early stage phase is just one phase about what we call your equity story. So I'm sure you already hear about this concept of equity story. So this means that your equity has to follow a kind of logical pattern. Of course, for instance, you got your startup, you just, let's say you are the only founder, so you got 100% of the equity, and then you will say, okay, I will raise in early stage, or maybe I will raise, let's say, $300K, and you will give 50% of your company. So this is not logical at all. So you have to follow an equity story. And as you can see on the graph, at the beginning, so as a founder, you got 100%. Then you will beginning to have some angels. So you will just give up a little bit of equity. I mentioned option pools. Option pool is something to have in mind. It's a mechanism. So you are going to take some share. We just save this kind of share in order to give them to your future employee. It's kind of incentive thing for a big employee, because when you are a startup, most of the time you can pay a lot. You can have very big salaries in order to seduce some new employees. So you can say to them, okay, I will not pay you a lot, like, I don't know, like a big company I don't know, Nestle or very big corporation can pay you, but I can give you some equity of the company. So this option pool is here from the angel round usually, and then again seed investor series A. And this is what I wrote on the slide. So you have to keep the right balance every time in your equity story. Then I am mentioning again some startup, just to tell you that this equity story is not like the pattern of every startup. You can see some startups which are going to bootstrap from D1, so they are going to just self-fund their business without asking any financing. Let's say like angel investor and mostly early stage VC or venture capital. And then I put some little catchphrase that it's very common advice we give to founders. You already see it in Medium, a post, or I don't know, in press article, on video, on TEDx talk. It's very good advice to have in mind always. So choose your co-founder very wisely, take friend and family money at the beginning. And every time it's better to have some advisor from the D1, and that's it, actually. So now we are going to have a very, very quick view about how venture capital funds are working, because according to me, if one day you will have a venture capital at your capital, so a venture capital will take some of your equity, you have to know what is the logic behind a venture capital fund. So basically, in venture capital, all is about money. This is not a legend. So we just have to follow the money flow of an investment fund. So I put the different step with numbers. So first, the fund is going to raise money through limited partners. So limited partners are usually called LPs. So we'll come back to LPs just after, because there is something to tell about LPs, and especially during this crisis we are going to live right now. So then the fund is going to source some startups. Then the fund is going to invest the money they previously raised with the limited partners. Once the fund invests in a company, it will support this company. It can be business support, it can be networking support, it can be marketing support, it can be partnership support with all the networking and the fund. Then you will have an exit. We will see the three kinds of exits, but the exit for a fund has to be with a return of investment, ROI. And then if you got this return of investment, you are going to give back the money to the LPs, and you are going to give back, not only the money they invested in the fund, but more money. So I wanted to talk about LPs. So these are the main LPs you can find behind an investment fund. It can be a seed investment fund, it can be a Series A, Series B, Series C. And so, yeah, I wanted to talk about the LPs, and especially during this crisis, this COVID-19 crisis, because I assume that you heard or you read on some articles that some venture capital fund will not invest in new startup for several months because of the crisis. So it's important to explain you why some people are rating this. So in order to explain to you, I will just show you how a fund is usually working. So basically, when you see on the press that a fund, let's say, raised $100 million, it does not have $100 million on his account. Actually, it's just a $100 million pledge, like some LPs just commit to invest in this fund $100 million. And the fund will just call this money at a regular intervals, let's say every month, every quarterly, or every year. So like quarterly basis, annual basis, or monthly basis. So right now we got a crisis, and all these LPs are in the crisis too. So even if all these LPs are contractually obliged to give to the fund the money they pledge, they're in this crisis. Their business are maybe going to decrease, and a lot of them are not going to do the cash call. And at the same time, the fund will not get angry with these LPs. A lot of funds just say that, okay, we will not call your cash, like, let's say, from March to, I don't know, to December to this year, but we will postpone the call for next January, for instance. Which means that there will be an immediate consequence for entrepreneur, because there will be less capital to invest for every fund in a short term right now. So this is why this is why some VC right now will be closed in terms of new investment opportunities. Some other will not be impacted from this because, for instance, they just raise a new fund, or for instance, they already finished the cash call, so they already got all the money and they still got some money to invest. So next, I will be very quickly. It's the key objectives of VC fund. So a venture capital fund is a business with key objective timeline. So it's basically the same thing I already show you during the money flow of the fund. So raising fund, develop a network in order to support the startup, select the best startup for sure, help the startup succeed, the exit. We will talk about the exit later. And then you are doing this again and again and again, because every 10 years you are going to raise a new fund. So this is why you are always constantly doing this. Same thing, like just a quick technical view of how the machine behind the fund is working. So on the left of the slide, at the left of the slide, you can see the different actors. So the general partner is usually the manager of the fund, so what we call the investment manager. Then we got the LPs, so the people I already talked you about. Then you got the venture capital fund, and the venture capital fund is going to invest in several portfolio companies. On the right, I just put a little bit of explanation about all of this. So general partner, it's like the manager. So it's him or her who is going to raise and manage the venture fund, actually. Then you will have the limited partner, already talked about this, the portfolio company, the startups, the venture capital fund. So it's very interesting. So usually when you are creating a fund, it's the lifetime of the fund is about 10 years. So the first 5 years are dedicated to invest the money you already raised or you are raising. And then the 5 last years are usually for the exit of your company. So during the 5, from the 5th years to the 10th years, you are going to sell the company you got in your portfolio. So we'll talk about this a little bit after. And then the management company. So of course they are going to be paid. So usually a fund will take a management fees, which is usually a percentage of the money the fund raised. And then at the end, when the fund will sell a company, they will take 20% of the capital gain of this sale and give back 80% to the investor. And so this is the exit. So like I told you, this is how the fund is making money. So actually there are three major exits for a fund. So first is a share purchase. So for instance, let's say your fund is an early or seed VC fund. So you are doing the seed financial round, then you are doing the seed financial round. And then you are just specialized in this kind of financial round. So you can do the Series A. So you are going to sell your participation. You are going to sell the startup you got in your fund to another fund, which is more specialized to Series A, Series B, or Series C. So this is the first one. The second one is about acquisition. So it's a strategic acquisition mostly. For instance, let's say you are doing a business of furniture in Armenia, and let's say you are going very well. one day IKEA is going to you and say, okay, I want to sell your business because I'm not in Armenia right now. So I'm going to buy your startup. This is an acquisition. And then you got the initial public offering. So the IPO, it's very well known when you are going to the public financial market. Then we're going to have a more practical look about what a VC is looking when you are sending your pitch deck and what they are going to ask you during the first meeting. So a little disclaimer about this. So I'm working like a legal in the fund, so I will just show you a quick view about it, but I will be happy after to exchange about it through email and stuff, because this is not the purpose of the webinar, but at the same time I just wanted to show you like the key assessment a fund wants to make when they're looking at a startup. So first, how do venture funds assess startups? So we will just talk about 7 things. This is the main 7 things venture capital fund will look. So first, the team. So of course the team, because you are at the beginning of your company. You got a business plan for sure, but maybe this business will change. This is what we call a pivot. So for instance, I think you all know Slack, so the message app a lot of people got on their computer or mobile device. So at the beginning, Slack was not a messenger app. It was a video game company, and the guy who were working for this company were just built a little chat between us, and then it became a Slack actually. So this is why we are taking a big importance to the team, because the business model can change. But if you got the good team to execute this business model or the new business model, it will be a very good thing for the future. So first is the team every time. Then you got very basic stuff like market and competition, of course, problem and solution. We just want to see if your product or your service is here in order to to cure a problem or to help people to do something. So you saw the problem, you identified the problem, and your product or service is the solution of it. Then the product, if it's a product, the go-to-market, the monetization, we talked about it, and the technology. So for the monetization, usually you're very, very young startup, so you still not have in mind your monetization model, but this is something you will have to discuss with the fund before any investment of the fund in your company. This is another thing, how the analysts in OneRagtime are looking the startup. This is the 4M rule. It's kind of the same that the 7th thing I just talked about. So the market, the model, the management, and the momentum. So the market, of course, market competition, or the competitor, the model, the same, like your monetization. How are you going to scale the business? What will be your market strategy to scale this business? The management, it's about the team, and most of it, because we are at the beginning, the only team is the founder, 1 founder or 2 founders or 3 founders anyway. And then the fast growth, because an investment fund is investing in your company to make your growth happen actually. So you have to show how you are going to scale, how you are going to grow, and all of this is usually linked to a momentum, because you know that this is the time to do it, this is the market to come in, like all this kind of stuff. And again, so on the same subject, in your deck, you have to put in your deck a lot of how to say assumption and output. Sorry, it will be very helpful for the analyst team. So it will show that you already know your business, you already have something structure in your mind. So it can be about your revenues, your HR expense you are going to have, your capex, profit and loss statement, all this kind of stuff. And usually the analyst team are going to assess your startup and broadly the business where your startup wants to go, with a lot of data, competitor, with market research, with database, even with the reference call for sometimes, and of course on internet. Then the the analyst team are going to use some ratios. So I think this is one of the famous ratios we got. This is the LTV on CAC ratio. So it's about the cost of acquisition of your customer and the lifetime value of your customer. So you have to always have a cost of acquisition of customer which is lower than its lifetime value. So this is a very, very famous ratio. So it's something very nice to have in your pitch deck or to show it or to disclose it with the VC fund during the meeting. And some other KPIs or some other ratios. So this is what I told you before. You have to have a little idea of your monetization model, because from this, the venture capital analyst will just put some ratio which will be linked to your monetization model. So for instance, let's say for a marketplace, they are going to the average or the value, the retention rate, for instance. So it's just like, it just have, how to say, it's every ratio are not here just to say, okay, this is a ratio. All the ratio are linked about your monetization model or your business model every time. And now we are going to the section 2, so which will be more about the process between a startup and a venture capital fund. So we will have a look about the timeline of a fundraising process when you, as a startup, are going to see a venture capital fund. But first, you have to ask yourself every time, does a VC make sense for you, like for your philosophy or for your companies? Because like I told you before, you can be a bootstrap startup which already can increase with its own revenues. So you can have some advantages, and you can have some costs to it. Let's say cons actually. So advantages, you will get an expertise, because of course, when you are going to get an investment from an investment fund, it's not the first investment this fund is going to do. So he saw a lot of different investment before. He supported a lot of startups before, supporting a lot of startups. So you can benefit from expertise. That's sure. You will have the industry network. So for instance, let's say you are a marketplace. The fund which will do the fundraising is specialized in marketplace startup. So of course you will benefit from the industry network of this fund. Then the credibility, of course, if you got fundraising from a very well-known investment fund, people will say, okay, there is a good team of founders, there is an idea, there is a good product, or there is a very good service. So you will gain in credibility for sure. And then you will have next financing rounds, because as I told you, when an investment fund wants to invest in a startup, it will not invest in one shot. It will want to reinvest in the startup to do the next financing round. But at the same time, you got some cons. So your fundraising is like a sale. So of course you are going to get money, but you will have to pay this money, and you will have to pay this money through giving some equity. So through giving a percentage of your company. We will see this after. You are going to get an investor in your capital, so an investor which is interested of your revenues, of your execution. So they will ask for expectation for a return of investment. So this is what they are selling to their investor, to their LPs. So you have to do it. Ask for a key performance indicator. So you will have to meet a lot of indicators in order to know if you achieving what you previously say to each other during the fundraising. Control, yeah. So fundraising is a sale. You will have to pay it. You will have to pay it with equity share, and you will have to pay it with giving up some specific rights. Talk about it just at the end of this webinar. And funder is like you have to be in Sorry, I was mute. I come back up. So yeah, so you have to be in a good momentum. Do you hear me actually?
Yeah, we can hear, but we lost the screen.
Oh, okay. Just give me some, just a second. You got the screen right now? The screen,
Yeah,
sorry.
Yeah, now it's perfect.
Perfect. Yeah, so the momentum, this is one of the cons. And so now we are going to the very practical thing, which is like how it's work with a venture capital firm. So the timeline. So we can divide it with a non-binding phase and the binding phase. So first you are going to send your pitch deck to the fund. Then you are going to, so if the fund is interesting with your pitch deck, with your company, with your idea, they will ask you to have a call in order to discuss about it, or maybe to have a coffee. And usually it will be one partner of the fund. So it will be your reference partner. If the fund is not interesting with your idea, so in OneRagtime, usually they send you an email and they say why they are not interesting. They explain maybe you are not in our, how to say, investment strategy, this kind of stuff. So then after the call and the coffee catch up, you will interest more the VC fund. So the partner, your reference partner, will discuss about your startup at the weekly investment meeting. So the investment meeting is with every analyst of the venture capital fund. Then you will have the follow-up from this investment meeting, what the other analysts told about your company. And if this is a good follow-up, you will go further and you will have to pitch your company. So you and your founders and maybe your key employees, if you already got key employees, and you will have to pitch in front of all the investment team. Then you will get very quick a yes or a no. If you got a no, it's okay. There are a lot of venture capital funds, so it's let's say it's normal, because there, how to say, like, let's say in OneRegtime, I can't remember how much pitch deck we get per year, but it's like the ratio, like from one pitch deck to one term sheet sign is like maybe 1 on 100, maybe it's around this. So let's say you got a yes. So then you are going to the binding phase. So the binding thing is all about negotiation and signing of a document. So the term sheet, I will talk about the term sheet just after. The due diligence. So the due diligence, it's like the investor will look at your account, your legal, your IP, your IT, in order to see if everything is clear, everything is recorded. For instance, if your trademark or your patent are registered to the good authority. They will check if you did all the, how to say, if you have no any issues with the tax administration, for instance. This is due diligence. Usually these due diligence are made by service provider, like by a law firm, accountant firm, this kind of people. Then after the due diligence, if the fund saw nothing which can not make it to do the deal, you will go to the shareholder agreement. You will negotiate this shareholder agreement. And alongside this shareholder agreement, you will negotiate the responsibilities and warranty, which are a document. I will talk about it after. And then when you sign everything, you will have the closing equal as signing. Then you will get the money transfer and you will be a part of the family of the fund. So now, let's say you get a yes from the investment committee. You are going to enter on the binding phase. So the first step of this phase is the term sheet. But first, I put something in red here because I want you to know that a fundraising is a sell. So I already told you this, but this is something I really want you to know, because sometimes we can see a press article, wow, it's very nice, this startup just raised 2 million, 10 million, wow, it's so good, it's very nice, they're going to have very good, very beautiful offices and stuff. But just have in mind that, yeah, fundraising is a sell. So you are going to pay this financing. And like I told you, you are going to pay with equity, you are going to give equity, and you are going to give up some business and strategic. So all is about negotiate this fundraising. And you can negotiate it through a lot of stuff. So through the valuation, of course, of your company. So you have to find the good valuation. And of course, I know we are at the beginning of the startup, so it's very hard to determine the valuation of the company, but you can do it. And as a funder, you can still negotiate with different things. You can negotiate with a combination. Sorry. So this is what I put in yellow on the right part of the slide. You will have this power to negotiate through showing that you got the execution. Like you are the founders. You can be you are the founder, which is the best in order to execute this mission, execute this business plan. You got the knowledge. You got the knowledge about the market. You got the knowledge about the competitor. Maybe previous you were working in this field, this kind of stuff. And you have to show the combination of the execution, knowledge, and the vision. Like you are thinking about your company one in long term, very long term. For instance, in 5 years, I want to be here, for instance. So this is the combination you have to show to the VC fund in order to have this power of negotiation as a founder. Same as a funder, you have to seduce the VC, and it's like very easy, not very easy, but you can find a lot of stuff to tell to the VC what he wants or she wants. She wants to hear. For instance, you have to research about the partner you are talking to. Let's check his Twitter account. What is or she is usually tweet. I don't know if they like this SaaS company because they are doing this. Check the portfolio of this fund, what kind of startups they already fund before, and check why, for instance. And you have to check the typology of the founder of these portfolio companies. Like maybe they got a founder pattern. So it's a lot of stuff that you can negotiate as a founder. But at the same time, you are a founder, so you are very well your company, your business, but at the same time, you will have to negotiate some legal clause. So you have to have a very trust legal advisor, and a trust legal advisor and someone who already working on investment term sheet, because this kind of term sheet, this kind of document is very standard. Like for instance, our fund is in Paris, London, and Barcelona. We got some term sheet from Spain, from France, from England. I saw some term sheet from Vietnam. Usually we got the same clause. So a good legal advisor is someone who already work on this kind of term sheet, who knows the standard documentation, who knows the different negotiation we can have. So this is very important. So as a founder, of course, you got the power of negotiation because you have to demonstrate that you are the people to execute the mission, to scale the company. But as a founder with a legal advisor, you have to negotiate the term sheet in a more legal way. So like I told you, the term sheet is very standard. So usually what we are doing term sheet is just a document with from 5 to 15 pages that the fund is sending to you. And there are a lot of clauses on it. And the purpose of this document is just to talk about this clause and to beginning the negotiation of it, because after, like you saw, there is a shareholder agreement. So in order to have a smooth process, the fund will just send you this document, and at this time you have to take the chance with your legal advisor to say, okay, this I don't want, this I want, this kind of mechanism, not this mechanism. So for instance, here are some common clauses you will find in term sheet. So you have to know that behind this kind of clause, the investor wants always to be protected. So for instance, the founder vesting clause. So let's say the investor will invest in your company, and in 1 year, let's say you say, okay, bye-bye, I want to work in another project, I am leaving the company. Like I told you, you are a young company, the investment fund will take a lot of importance about the founder. So if 1 year after the financing, the founder wants to leave, the fund will say, okay, sure, you can leave. But let's say that you were holding 60% of the share. So the investment fund will say, okay, you can leave. I will buy back your share, but I will buy your share not at the market value. I will put a discount. And first year, it can be an 80% discount. So this kind of clause, usually it's 5 years. So after 5 years from the fundraising date, from the signature of your shareholder agreement, you can leave the company with the buyback of all your share as a market value. Then you will have the board decision and composition. I will talk about it later. Preferential liquidation, same. I will talk about it. And Ratchet, I will talk about it. So it will be the last slide of the webinar. It's kind of technically, but I just want you to just have it in mind. So the day you will have your term sheet, just spot this clause, which are very, very tricky clause. So first, we will talk about the ratchet. So this is just an example. But at the beginning, I will just tell you what is behind this ratchet clause. So this clause, so the purpose of this clause is to grant to the investor, to the fund, an anti-dilution right. So anti-dilution right is something like which is not very, how to say, famous. So you have to know that anti-dilution right is just a provision that gives to the fund, okay, the right to maintain its percentage of ownership in your company by buying more shares in this company during a future fundraising. Okay, so I just say this from the. Then you are going to check the example. So for instance, let's say that a VC is going to invest like 50K, so early stage, in a startup which is valued at 450K. So with this investment, the VC will have 10% of the capital. That's it. And then in 2020, like the startup is doing bad. It's all the promising contracts the startup said to the investor, okay, I will get this contract, I will get this partnership, it will raise my sales and stuff. Nothing of this appeared. So he burned a lot of cash, no revenue, so he has to do a new fundraising. But the company was, let's say, here in 2019 when the VC invested, and now it's like here. So there is a very big decrease of the company. So what we are going to do is we are going to, okay, I am going to fundraising you, but with a down round. So which is say that your company, which was valued at 450K before, I will now value it at 250K now. But if you are doing this, the value of your investment in 2019 will decrease too. So you will be a down road of your investment because now the company is 250K. So the 50K you put at the beginning for 10%, now it's 25K. But the investment fund, of course, during the term sheet, you negotiate. And with this ratchet clause, it's enables the investor the right to say, okay, I want to maintain my 50%, my 50K investment in your company. So I will have new share in order to maintain my first percentage in your company. So in this example, for instance, the fund will subscribe 10% more share. But you have to know that you will not create this share. Like the investor is going to take this 10% of share from your VC at 10% of the capital, you add 90%, then you will just have 80% of the capital. Okay, so this is something very, very tricky. sheet. So if you got a legal advisor, you can spot it and you can negotiate it. You can say, okay, you can do this, but we can put some threshold, we can put a lot of different mechanisms. But in the term sheet, of course, the clause will be like this, okay? You will have to negotiate it. Then you will have the liquidation preference. So it's easier to understand. So you just have to know that, let's say this VC is going to invest, again, 2 million in a 10 million valued company. So after that, you will get 20% of the capital. Okay, good. 2 years after, the company will be sold for 12 million. So if you want to know how much the fund will win, you just have to take 20% of this 12 million and you say, okay, easy, as the fund will get 2.4 million. Very good. But a lot of investment funds put a clause which is called liquidation preference. And with this clause, like the investor will get the money they invest, so the 2 million they invest first, okay? So you just sell your company 12 million first. This 12 million is for just the investor. Okay, me, investor, I will take my 2 million back. So I already got 2 million, good. Now we got 10 million. And me as an investor, okay, I participate to your company, I put 2 million, so I had 20%. Now I will take 20% to this remaining 10 million. So as we'll have 4 million in total. So it's very tricky too. And mostly it's very tricky for the angel investor to invest in your company at the very early stage. This kind of investor doesn't have any liquidation preference and stuff. So the fund will come before, take the money for him, and then he will say, okay, guys, you can now take money. So of course, it's gonna decrease the capital gain of the other non-professional investor and of the funders, of course. And then the last one is a board decision and composition. So you have to know that when a fund will enter in your company, will fundraise your company. I told you it's a sale. You will pay it with equity or by giving up some rights. And this is what I was talking about. So when an investor will come to your company, they will ask for creating a governance body, which is called a board. And in this body, they will put the founder, or like if there is just one founder, if there is three founder. So the founder, the investor, and it can be another people which is appointed by the investor. And in this board, in the shareholder agreement, the investor will say, okay, all these kind of decisions, I want you to take it through the board. So every time you want to, I don't know, increase the salary of an employee, going to, let's say, going to Spain market, going to, to open a new office in Japan, for instance. All this decision will have to be discussed during the board. And so the investor will have something to say about it. And sometimes, no, most of the case, the investor will put a veto right, which means that even if you are all the founder agree with this decision, the investor can say, okay, I am alone, but I've got the veto right to say no, so you can't do this. So it's, again, so you have to be very, very picky. Of course, in every shareholder agreement, in every, term sheet, you will have a board decision and composition clause. And then you will have to be very picky about what kind of decision the investor asks to be deliberated in the board. Okay, so it's the same. You have to be like, you have to have a very good legal advisor to check this. And that's the last slide of the webinar. So I was talking about term sheets and sometimes to shareholder agreement. So the term sheet is just the first standard document. And according to me, it's a very, very important one because like I told you, you can already negotiate the term sheet. And maybe you will take a lot of time to negotiate the term sheet, like it will be a ping pong. You will send your markup to the investment funds and the investment fund will come back with a markup. Then they will say, okay, there is too much negotiation to do. Let's have a call, let's have a meeting and you will talk. But when you are doing this, after that, you are signing the term sheet. And then you will have to negotiate the shareholder agreement. And the shareholder agreement, like I wrote, is like the term sheet, but very like it's more precisely than the term sheet. But the fact that you already spot every big issues on the term sheet is going very smooth. It's going to be very smooth to negotiate the shareholder agreement, actually. So yeah, so according to me, on this last part, you have to negotiate always. A fundraising is not something which is very cool. You have to pay for it, and if you have to pay a certain price. So you have to negotiate it. So that's it. Once again, sorry for the French accent, but I hope we are in the good time. I hope I wasn't very how to say, not quick. And if you got some question, like, do not hesitate.
Okay, so thank you, Vincent, for the presentation. It was really interesting, and I guess it was interesting for all the participants as well. So we can now go on a bit for the questions.
Yeah.
And yeah, everybody are free to ask the questions they have, but we'll start with the one that is already given by David Iskandarian. So he had a question: what are the average market fees for the fundraising? Because during the presentation you told that like you have to pay kind of for for getting the funds. So what is the average market fee for that?
Oh yeah, so actually when I was talking about the market fees is it's more about the investor. So let's say that the fund is going to invest to a startup, but like I told you, the fund is himself invested by LPs. So when I was talking about the market fees, it's how much the LPs will pay the fund in order to manage their money. So of course, the startup will not pay any market fees to the fund. So it was my mistake. Like I was just talking about how a fund is going to earning money by the investor.
Yeah, I guess because the question was during the part of when you were telling about when and how to raise the money, maybe it was just wrong wording. That was the case. But in general, he has another question related to it. Like, is it typically the case when there is an intermediary between the startup and the VC? Is it like, does it happen?
Yeah, okay.
Like that?
Yeah, so sometimes, yes, so sometimes you got some intermediate people who are coming to see a fund and say, oh, so for instance, every day we got this kind of email in OneRagtime. So, hey, hello, OneRagtime team, I got a good startup, like to say a marketplace startup, which is specialized in this. These are their revenues, these are some ratio. Do you want to invest in it? We never invest in this kind of startup because we are not working with this kind of intermediary people. But I know, yeah, some startup are just hiring a guy, which we're going to do the pitch deck, which is going to help the startup and the founders to go to see the VC. But at the end, this guy, so the intermediary guy, will take a little percentage of the amount raised by the company.
Okay, so can we imagine it that if the fundraiser is not the part of the core team, kind of it's an issue for the VCs to deal with those kind of teams?
Yeah, it can be an issue because the fundraiser is not a part of the company. This is a business of the fundraiser to just have a lot of company fundraised by a fund. So we don't know if the fundraiser is really believing in the company.
Okay.
So this is why we are not taking this kind of like you say fundraiser kind of
Okay.
proposal.
Okay. So we have another set of questions from Anna Gevorkian. So first of all, she says thank you for the presentation. So those are the questions. Which of the financing models are mostly used by your VC? So equity, loan, or convertible notes? Do you use safe pre-money or post-money terms? In your example, you have used pre-money valuation. And so we can go one by one because there are like
sure.
questions. Yeah.
Yeah, so which of the financing models are mostly used by your VC? We use like 90% of time equity every time. Yeah, let's say every time we are using equity. Why we are using equity? Because we are more comfortable about this. And there is something which we like to do is, how to say this? Most of our funds are tax incentive for our investor, and this tax incentive is only working if we are investing in equity in the company. So, which is another reason why we are mostly investing in equity. For the second question, but actually, like I don't know a lot of funds which are doing loan. Convertible notes, I know it's going to be big, but right now we did one in convertible notes. That's it. Do you use safe pre-money or post-money time? So we never use safe. It's well known in United States. In Europe, there are some. We never do safe, and usually when we are investing, we are always investing on a post-money valuation. So yeah, in my example, I put pre-money, but yeah, right. You are always investing in post-money. Then, do you have eligibility requirement for startup, either in industry or geography? Yep. Usually, we are investing in Europe, in European companies. Sometimes we got two in US, but we are happy to scout other countries for sure. And actually, not like in any policy which say, okay, not in European Union, not in US, we are not going to invest. So we have no any eligibility requirement. In the industry, we are investing in any tech startup except hardware. But we are like, it can be fintech, health tech, legal tech, insurance tech, mobile tech, like it can be everything. Who is estimating the valuation of startup companies at seed stage? Investor or funders? Oh, that's a little bit tricky. I will be both, of course. As a founder, you know, as a founder, I mean, when you are going to see a VC, not at the first meeting, but meeting after meeting, you already got an idea about it. But usually, it's not very. Usually, it's not very how to say difficult to do it, because this is about three things, like how much the company want to raise, like the price the company want to raise, how many percentage the company want to give in equity, and that's it. This is how we evaluate company most of the time, because it's very young company, so there is no any how to say there is no any product or big revenues. So there is sometimes product or services, but there is not any big revenues. So all the ratios I show you, we are using this ratio as a clue in order to just check if we are in the good range of valuation, but we can't use this ratio to have a proper evaluation. So yeah, so it's investor and funders, but funders already got every time a little idea about the valuation. Taking into consideration this pandemic lockdown period and the crisis resulting after that, is your VC going to finance any startups this year? Yep. So actually, right now we just send a term sheet to a company which is in a credit score rating. And we are doing all the call in Zoom. So yes, we are still investing. OneRagtime, like I told you, so at the beginning I told you OneRagtime is a fund which is investing through a fund, like all the funds who are existing in the world, like the thing I told you, the LPs which are going to give money, and that's it. And we are investing through investment vehicles, and this kind of investment offer is very nice in this kind of crisis, in this period of crisis, because it's like we identify the company, we put it on our investment platform, and we just say, okay, guys, who wants to go and invest in these companies? So it's very good to have this kind of, it's crowd equity, this kind of crowd equity investment offer in OneRegtime, will allow us to still invest in some companies. And again, we are investing in early stage and seed, so we are not investing like 5 million, 6 million. So it's easier for us. So yes, we are still investing. So like I told you, we sent a term sheet, and the deal flow department of the fund are right now maybe see 3 or 4 startups. So yes, we are still open for business. And if yes, are you going to change your approach criteria of startup assessment? So it's a very good question, because before the crisis, a lot of people were saying that, okay, what's happening right now, like all the big valuation of company, it's just crazy. Like, because we saw a lot of company who raised a lot of money at a very big valuation. And according to me, we were before the crisis to a very crazy full system, according to me. So this is the case in US for sure. In Europe, less. In Asia, it's okay, but we are in a very crazy situation. So according to me, the fund will be a little bit more how to say, a frozen head. Like they will be maybe more how to say, more careful about the valuation of company. So for sure, the fund in general, us in OneRegtime, if you are checking, we never invest in big valuation company. We every time we try to, so for instance, when I was told you about the negotiation of the term, we prefer to say, okay, we will not put a ratchet, but we will take a little valuation of the company. So we prefer to invest in a little valuation than a big valuation and put a lot of bad close to the founder. Then how we can apply?
There is one question actually which was sent to me privately. So if you
okay.
don't mind, I will just, and it's going to be quite interesting question, and we can merge it with the last question. So it's again from David Iskandarian. So the question is that about raising money in distance. So when you live in a small country like Armenia and you need to attract funds from foreign country-based VCs, so what is the effective way or ways to reaching those funds that they are abroad? So this is the question, and we can combine it with this from the ERP Smart system. Like generally, can Armenian startups approach to your VC? And what is the investment amount that on average you are doing?
Yeah. So today, so actually on our VC, like most of the VC, you are going to the website, and there is a tab which is called Send Your Deck. So of course, so you can do it, and yes, after how to say, let's take for instance Crisp. For instance, Crisp, I know that my boss, one of my boss, was very sad to miss this kind of opportunity, for instance. So according to me, we were not very famous. We are still not very famous like the big Bartek Sequoia fund. We'll never be as how to say, as famous. But for this kind of company, when you are in a country far from VC-based countries, usually, according to me, you have to target not the big Sequoia and stuff. So you can do it for sure, because like even me, if I had a startup, I would be very happy to have Andersen Horowitz, Sequoia or Partek in my startup. For sure, I will be very happy. But at the same time, it will be very smart and wise to target some middle funds, so which are not very famous, but which are doing great job, which are maybe some partnership with investment European fund, this kind of stuff. And it will be, for me, it will be like easy, not easy, but it will be, how to say, I will not be surprised to see some French or at least European-based VC to invest in Armenian company, for sure. Yeah.
Okay. There is another question. It comes. Yeah. It's from ERP again. Like how long it takes the investment process, and yeah.
So usually, so in the investment process, I put the binding and non-binding. On the binding, so from the day you send your pitch deck, let's say from the day you send it and from the date you got an answer yes or no, let's say there is 2 weeks, then it's going very fast. So you see again the partner is presenting the project. Sometimes even if we like a lot the startup and we want to secure the deal, we're going to send a letter of intent, which is a very little document. We say, okay, let's talk together. So the fund and the startups, like with an exclusivity for, let's say, 3 weeks, and we are going to do everything very, very fast to go in the binding phase. So first phase, non-binding, I will say max 1.5 months. And for the binding one, so from the sending of the term sheet and the signing of the shareholder agreement, so let's say the closing, the day you get the money transfer, it depends. It depends. If you got a very good legal advisor and if you are very good in negotiation, you will have a lot of ping pong between the fund and you on the term sheet. It can be again 1 month to 2 months. So let's say from 1 month to 3 months. But sometimes it can be very quick. I remember we already did in 1.5 months, and we had the binding phase and the non-binding phase, the non-binding and the binding phase in 1 month. Yeah, 1 month. Yeah, it's already happened.
Okay, perfect. Are there any other questions from the
do you have any pathology startup in our portfolio? We don't have pathology startup. We got health tech startup, which is doing some data with health medication. But no, we don't have any pathology startup. But this, I don't know who is ERP smart system, but we'll be happy to have his deck on OneRagtime.com. Because we already invest in health tech, and it's one of the subjects we are screening since now 2-3 months.
Okay, and actually I have another question that's personally is quite interesting for me and for many maybe like Armenian startups. So because in Armenia there are like only 2 VCs, if we are talking in that way, and a few like angel networks or angel clubs. So startups are usually used to go to different kind of events, to different kind of showrooms, like to show their startups. Is it a typically place where the VCs are going to see those teams, or it's more like usually for you just to get the pitch deck, and the VCs don't typically go to huge events to get the startups?
Oh, it's a good question because we receive a lot of pitch deck per year. So like the basic thing, like a startup go to our website, is going to send the pitch deck and that's it. But according to me, it's very nice to go to this event because I can see even myself. There is sometimes, not always, but sometimes when we will have a mail from one of our boss of one of our partner will say, oh, I met this guy at this event. I met this guy at this event. They are nice. They have a good project. It will be, it will be easier. So for instance, if we got this kind of stuff, or let's say tomorrow we have one of our boss of one of our partner will say, oh, I met this guy. They are very nice. We are going to send a message to this guy to have their pitch deck. So according to me, it's very nice to always networking. That's, for me, there is no doubt about it. After, if there are a lot of VCs in this kind of event, it depends actually. But I think usually you can see, for instance, if there is an event with some people who will speak, like a panel, this kind of stuff, you can see if there are some VCs. But even if there is not some VCs and there is like angel investor, or there are some people who are working in the, let's say, startup ecosystem, it's always nice, even for angel investor, because angel investor, they know some partner of fund, of course. So maybe sometimes there are the guy who are saying to partner, oh, I know you like fintech, or I just saw a guy or girls who got fintech in an event in Armenia. I will send you the deck, or I will put you in relation with them. So it's good. It's good to network every time.
Okay, and I have another question. Actually, it's about like difference between the angels and the VCs. Okay, we know what it means in words, we know what it means in theory, but as a startup, like what's more essential, with whom to cooperate, and what are the typical issues that you think that I can face while working with the angels? Like not separate angel, but with the like angel networks or angel clubs. Are there issues, or and what are they, if you
Yeah,
any?
so actually between angel investors and funds, so for me, so I say angel investor, it's people like you and me, or people who got money and who can invest. So like not like me, but like natural person, let's say this.
Yeah.
And the fund, I am talking about a professional person. So there is a step. So at the beginning, of course, you are going to get angel investor, because it's, how to say, it's easier to raise money with angel investor. You are raising not a lot of money. You are raising, like say, 50K, 20K. It's very easy to have it from angel investor. Then these angel investors are not professional. Usually they are working in their own stuff, or they are retirement people, and they don't have a lot of expertise of your business. So of course, when you are going to give equity to angel investor, so one angel investor or a group of angel investor, a club deal, of course you have to be very picky, like to not accept any of the clause I just show you, because they are just angel investors. So according to me, angel investor, you just have to take the money, some advice. Okay, sure, you can have some advice, but do not put some board, for instance. Like do not put a board when you will need the approval of the angel investor. You know, it's just for them, it's just putting money in your company because they know you, because, for instance, you are in the same school, because of relation. That's it. And because sometimes I saw some startup when they accept a lot of things about the angel investor, like a seat in a board, a lot of stuff, and the angel investor is not professional, does not have the expertise. So it will be very tricky at some point to have a guy to say, okay, I put money in your company, I want you to go here, I want you to do this, I don't want you to take this decision. So you are to be very, very cautious with this kind of investment. And like I told you, like it's different step. At the beginning, you got angel investor, that's it. And after you got a fund, and this fund will have this expertise and can go in a board and this kind of stuff. But you have to protect yourself with angel investor. Angel investors are just going to do a financial operation, and that's it.
And I have another question, which is about like further rounds. For instance, if you have raised the seed round, actually, when you were talking about the numbers in Armenian, the seed round is like 20 times less from the numbers that you were telling. So it's a bit,
yeah,
yeah,
it's very funny.
yeah.
Yeah.
So when, for instance, you are getting to Series A, let's put in this frame, like what typically the previous investors may influence on while you are taking the second investment? Is there some tricky points that the first investor, like VC, can put you in a trouble for the later investments?
So usually, when we are coming as a first professional investor, there are some angel investor in the company already.
Yeah.
So yes, already, yeah. So usually, in this kind of operation, they are they are not they are the people who are losing at this financing round, because it's like you invest as an angel investor, so with not a lot of protection, and then you are going to have an investment fund which is going to invest after you. And this investment fund, like I show you, will ask a lot of stuff in the term sheet. And just for instance, on the liquidation preference, like this is a perfect illustration of the thing. Like if there is a sale of the company at a little, like let's say the company was 10 million and the sale will be at 11 million, you know, like very, like a little capital gain. So the fund will take first his thing and then it will take its pro rata of its participation. So of course you will decrease every investment of the angel investor. So, but according to me, it's the same. Like if you are an angel investor and you are going to invest on your own in a company, of course you can't negotiate anything. If you are an angel investor, which are a lot of friends, and you are going to create a holding, like an investment vehicle, like we call the club deal, so you can inject way more money to the company and you will maybe have more right to ask for this. But usually, yes, when we are going in Series A, there is already some accelerator, for instance, but usually the accelerator are staying in the company. For the angel investors, sometimes they can leave or they can stay, but they will stay, but at the end, they don't know if they will have the capital gains they were expecting because of all this clause.
Okay, thank you. So just if there are any additional questions, we can ask. If no, as already told, we will put the video of this webinar on our Facebook and on our official webpage.
Yeah, sure.
So you can see, and I will ask also Vincent if we can have the pitch deck there as well, or it's not like.
No, totally. I will send it to you like just after. Yeah,
okay,
totally.
Perfect. So I will put it there, and there will be the announcement where you can download it or just go and see it. So you can have everything there. And once more, thank you so much for the presentation. It was really, really interesting.
Okay.
And I guess it gave like quite much information to the people participating. And now, if they will deal, they can do it easier. And I think everybody are free to send their pitch decks if there are some people who are interested to work with your VC. They can send their pitch decks directly to, as I understood, on your website, there is a place to do it, yeah?
Exactly. And anyway, if they want to talk about, I don't know if they got some tricky, because I know right now with the crisis, a lot of investment funds wants to take advantage of this and say, okay, I'm going to come to see startup and say, okay, I will invest in you with this very, very low valuation, and I will like take advantage of this crisis. So do not hesitate to send me an email or reach me on LinkedIn. If you got some problem with some bad investor, like I'm here at your disposal. And if you got pitch deck, you can send it through my email or on the website, like you told it, Ovanes, there is a link to put your pitch deck.
Okay, thank you so much, and we will be in touch. I'm pretty sure it's
sure.
not the last time that we are working together, and it's not your last time. Last time when we went in Armenia, you're gonna be here many more other times. So
exactly.
Hopefully we will have a chance to see you personally once more, and the participants or any other startups will have the chance to meet and discuss their project personally with you. So
totally.
Yeah. So thank you everyone for participating, and stay safe. Hope that everything will go well, and in a few weeks we can get back to the normal life.
Exactly. Thank you very much. Bye-bye. Thanks for having me.
Bye-bye. Thank you.